Rogue Macro here, back with another live stream. So, CPI comes out every month, usually about a week, in the second week, sometime in the month. And so I like to go live. Forgot this one was dropping. And so I am kind of last minute putting this live stream together. I am going out on the Telegram community. Check that in my bio or the description wherever you're watching this. I'm also going out on Twitter at rogue macro underscore kick and YouTube. Haven't live streamed on YouTube for a little while, but we're going with it. So, all right, let's check this out. 8:29. They come out at 8:30. So let me refresh this page. This is simply bls.gov/CPI. As you can see back here in December, 0.3%. I'm expecting this to be lower. Trueflation, which is a newer measurement, a newer metric of price inflation, that has been trending down under 1% for their year over year numbers. They're more real time and more directly price sensitive, where CPI has a lot of built in baggage of uh, hedonic adjustments, and it's been going for so long that they've updated the formulas, especially when it comes to shelter, substitution effect, all that stuff. So CPI has a lot of technical debt behind it. Trueflation is a lot more up to date. So I do like Trueflation a lot. There's other ones like Chapwood Index. Chapwood Index has a stated bias, so I don't like those alternatives. Of course, the U.S. government has a second alternative, which is a PCE, and the Fed likes that one. Excuse me. Early morning here. Let me get a drink. All right, we got 8:30. Let's see if we refresh. We got it. CPI for all items rises 0.1%. Or sorry, 0.2% for January. Shelter up. Shelter is one thing we've been watching. It's very laggy. It has a built-in at least 12 months lag, but it seems like it's going on almost 3 years now that shelter is trying to come down. So that's what we got. We can see the components right here. All items just over 0.2 or just over 2% year over year. 2.4%. So I think that's down. I think people were expecting it to come in at 2.7%, but we will get into the nitty gritty here, and then we'll also go back and look at the market reaction. So let's jump into this. Yeah, continue. Oh no, I don't want to do that. Okay, this is not coming through. Let's go to this one, this screen. I think that helps a little bit. Make myself a little bit bigger here. All right. So we got the consumer price index here, increased 0.2%. Now we don't know if that is below rounded up or rounded down. I think it's probably going to be ended up rounding up. So it's going to be below 0.2%. And remember that magic number for the annualized is under 0.17 is 2% annualized. And that's their goal. Their goal is 2% um, year over year, quote unquote, price inflation. We had to talk all these technical terms because, this is not really inflation. Inflation is adding more units of currency. Um, and, but these guys measure prices. Now, in the old days, they did measure actual monetary units, but as cash and cash equivalents got harder and harder to define throughout the decades, 70s, 80s, 90s, they just dropped counting M1 or M2. They tried with M3, that didn't work. They got rid of M3. M2 is the most exotic that they have now. But those things do not match what actually is happening in the economy with prices and stuff. So they just said, hey, let's forget about counting the money. Let's just talk about prices. And so that's where we're at. So this is not really inflation. This is price inflation. And then, of course, then you have regular inflation. That's actual currency units. But so, and yeah, their goal is 2%. And to get to 2% annualized, which they just sum up the different months, it has to be under 0.17. So, anyway, seasonally adjusted basis over the last 12 months, all items increased 2.4%. All right. The index for shelter rose 0.2%. That should be down, actually. Let's go down here and look at shelter. Yeah, shelter is disinflate. This is disinflation. So it was 0.4% in December and a 0.2%. So why are they saying shelter is up? Shelter is down, unless you're looking at services less energy, um, which is the category above shelter. Uh, that would be up. But shelter itself here is down about half. So that's interesting. Let's continue reading. See if I have any comments or listeners on Telegram, the community. Like I said, this was last minute stream. Yeah. Well, I'm recording this. I'll put this out for Telegram too. All right. Largest factor in the all items monthly increase, the food index increased by 0.2% over the month, as did the food at home index, while the food away from home index rose 0.1%. These increases were partially offset by the index for energy, which fell 1.5% in January. And yes, I did notice this just at the pump and other places that energy has been going down. And this plays into some of my long-term expectations here. So I'm on the side of deflation or disinflation in the economy, and energy is a big driver of that. So I have been expecting oil to be stubbornly low, and that's what we've seen very recently as well. But yes, it's been stubbornly low for a while. The index for all items less food and energy rose 0.3%. Okay, so core rose 0.3%. Indexes that increased over the month include airline fares, personal care, recreation, medical care, and communication. The indexes for used cars and trucks, household furnishings and operations, and motor vehicle insurance were among the major indexes that decreased in January. Okay. The all items index rose 2.4% over 12 months. So these are very close. All right. So year over year headline was 2.4%. Where's that? 12 months, 2.4%. And core over year was also 2.4%. But headline is lower month over month, and core is higher month over month. I do like looking at month over month versus year over year because you don't get the change in the year over year. It takes a while to price in. Like, let's say you have a bunch of months that are very hot for inflation, and then you had one that was cool, and that symbolized a qualitative shift in the economy. Well, you're not going to see that qualitative shift if you're looking at year over year for a long time. You're talking 6, 9 months before that gets priced in, this qualitative shift. And so it's better to look at month over month. Now, if you're wanting to do more than month over month, I would stick with like quarterly. So what is this doing on a last 3 month basis? How about the last 6 month basis? That gets you, this is a middle ground. You can also then go further than 1 year and look at 2 years or 3 years and get like a general trend in the economy. But overall, I like month over month better than year over year, but it depends on the situation. Okay, so that's what they have here. Let's take a look at some of these individual components. Energy from positive all the way to negative, and that's the first negative in energy since July. Um, and it's pretty negative, actually, over 1%. Energy commodities, negative 3%. Gasoline, negative 3%. What is this? Fuel oil, almost negative 6%. So, yeah, that had a big change in the economy. Used cars and trucks, negative 1.8%. The biggest gainers here: transportation services plus 1.4%. Piped gas service is 1% plus 1%. But overall, that looks pretty decent. Now, like I said, the truflation is down under 1%, and CPI is still sitting at 2.4%. But we will see how this changes over the next couple months. Let's take a look at prices and how it is evolving here. And let's see if my sharing screen is still working fine. Yeah, that'll work good. Okay. So take a look at some markets. So we'll have a futures, but they'll be delayed. Futures market will be delayed by 15 minutes. So we don't have the reaction here quite yet to that. Oil, no reaction really to oil. How about the US 10-year? Now this is interesting. This is interesting. Hey, what's up, guys? Watching, like, comment, subscribe. If you're watching on Twitter, make sure you follow, like, and retweet. If you're watching on Kick, follow. I haven't been streaming very much there, but I would like to do all these live reactions and stream them there. I think that's an open platform that can get more people on it. And for events in the future, I would think it would be fun to stream on Kick. So that's one reason why I am going on Kick. And of course, YouTube, like, comment, and subscribe. See what's going on Telegram. Reed showed up. What's up, Reed? I'm going out on the other platforms as well, and I'm recording this so I can get back. You can watch this a little bit later. Bottom line is that CPI came in at 0.2% month over month, which is down, and the year-over-year number fell by, what did it fall by? Like 0.3, so it fell quite a bit, and I'm not sharing my screen with you guys. So let's make sure I do that. There you go, Reed. We're looking at a 10-year here, and one thing that, I expect this to fall. I've been expecting this to fall. I am a bond bull because uh, in the past, I have been generally waiting for this recession to happen. And as we waited, like a lot of times people, if they're bearish or if they're thinking an inflation is coming or recession is coming, then they will be doomers and they'll pick out different things and be like, look at this is terrible. It's a collapsing right now. Well, I never said that. I was never a chicken little about it. I said I expect that we are heading towards a recession. But until that period, we're going to sit in this pocket. And I called it a pre-recession trade, a pre-recession period where certain things, would characterize the pre-recession period. And that would be a falling interest rates. It would be falling oil price. It would be generally a strengthening of a dollar, or at least the dollar hanging out and not weakening. Um, Positive for the stock market and positive for Bitcoin and gold. So that was this little pocket. Not that anything would explode or collapse, but we're sitting in this pocket in a general trend in a pre-recession period until things got to a point where it broke down, and then we would go into like a recession trade. Okay, that would be very negative for stocks, probably negative for Bitcoin, um, and very positive for bonds because yields would collapse, right? And we would see oil probably collapse and these other things. So that was my idea, was this pre-recession spot that we could just sit in and wait. Well, now over the last couple months, I've started getting more bullish for the US economy. I'm s- I'm still equally as bearish for I'm still as equally as bearish for the global economy, but when it comes to the US economy, I'm getting more and more bullish. And so when I've been expecting the US 10-year to slowly decline in this waiting period, this pre recession trade, what we saw here actually was the 10-year make a move up. You can see, so as we were moving down, And we can put on the Fed funds. And let's make this a line so that it's a little bit easier to see. And what is this? Why do I have this parallel channel in here? Hide this. Okay, so as you can see, the US 10-year was under the Fed funds policy, which was up here, is stubbornly below, inverted yield curves everywhere. Then they started cutting. The 10-year was right inside the Fed funds, kind of came down. They kept cutting, and it was rising. This was rising right as kind of like growth expectations were actually starting to get a little bit exciting in the United States economy. And we broke out here. Um, and I said, this is pricing in um, future growth expectations. And I said, okay, maybe if this is the case, maybe we continue in this channel. Well, look what's happened. It's come down, broken down back out of this channel. And that is bearish. So going up is bullish for the economy, going down is bearish for the economy. And that's where we're sitting. Let's take a look at the 2-year stuff. Start with the 3-month. Okay. So this, and we can bring up SOFR as well in here. Okay. So we got SOFR and the 3-month. Zooming in. All right. So we don't really like to see the 3-month towards the top of the range. That tells us there's a little bit of stress in the system. I mean, being below the range also shows us stress. But what we kind of want is what we see right here. Back at the beginning of last year, SOFR and the 3-month Treasury bill, they were towards the bottom, the bottom half of the range. And as we go back, let's go back, especially SOFR here. The 3-month back in this time in 2024 was right in the middle of the range. So the middle to the bottom, that's kind of where we want to see this. That means there's not too much stress. Blah, 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 I'm whistling here. Not too much stress in the system. But then we saw this come and break down. And again, look, you can tell that the Fed just follows. So this broke down in August, and they didn't cut until September at their next meeting. So see, they just follow what's happening in the market. You can tell that. All right. The interest rates lead the Fed. All they have to do is follow. Then we got a period here where it was relatively low stress. They were able to control the narrative and things were happening okay. We did have periods where the SOFR was spiking, and that is extremely stressful for the financial system and the banks. Um, Even out here, before they cut again, September 15th, there was a spike above the Fed funds range, and that was a bad sign. So, one reason why they started cutting, of course, the 3-month was under and leading the whole time, including right here in December of last year. The 3-month was below and led the Fed. But we had all these spikes in SOFR, this was an extremely stressful time for the banking system, for the financial system. And that didn't even quiet down until the getting into the first of the year. Right around the end of the year, into the first of the year, we started quieting down. So for now, sitting above the middle of the range, 3 months sitting above the middle of the range. So this is telling me that I would like to see it down here in the bottom half, and that would tell me yes, growth is expected, and that's one reason why the 10-year is climbing. But this tells me there's a little bit of stress, and that does match with the 10-year now dropping out of this, dropping out of this. And, we haven't quite got to this bull market yet. We haven't quite really got the confidence in the economy, but we will see what happens this year. Of course, we do. Then we have to start thinking about the bottlenecks of the year. financially, and those are end of Q3, or sorry, end of Q3 is the most important one, but end of Q1 as well. So we do see a lot of financial squeezes and crises that happen, and banking crises that happen around the end of the first quarter and the end of the third quarter. And I've talked about that seasonality a lot in the past. But okay, so that's where we're sitting. What's up, Boog? We're just going through a few charts here, looking at the market reaction. The US 10-year selling off a little bit here on the drop. If we go back to our main stuff, Bitcoin's reaction is positive. Let's go to the hourly. Somewhat positive, but we'll see how this plays out. Gold, somewhat positive, but nothing significant. The dollar, interpreting this negatively, I guess you could say. But again, nothing too significant to see here on the reaction to the drop. I think people were expecting this drop to, or this CPI to come in roughly where it did. Maybe they were a little bit off on the year over year, but 0.2% is where I saw. I did see actually some predictions of 0.25, which that would round up to zero point 0.3 on a month over month. So coming in at zero point 0.2 was probably below expectations. We can actually take a look at Zero Hedge and see what they were thinking. Okay, is this refreshing? I hope so. All right. Okay, this was premium. Okay, we got a drop here. So the headline is US core CPI tumbles to lowest in 4 years, real wage growth surges. So this does play into this bullish economy for the United States versus other places. And you can see it's starting to sell down here. Or not sell down, but, come down year over year. This month over month bar, let's make this bigger if we can. Click it. Okay, so the bars here is my fat head taking it up. Yeah. Oh man, I gotta change this up now. Okay, I think you can see that. So this is month over month, and you can tell where the month over month was screaming during COVID, right? Are you seeing my cursor? Yeah. Month over month, screaming up here. Then I was telling, I was talking about this at the time. We were live streaming about this. I was writing about this. I was saying, we're going to hit a brick wall because prices are going up, but the people can't afford it. Yes, we got these stimmy checks. Well, those stimmy checks ran out. Okay. So prices cannot continue to go up if the people can't afford it. They're going to cut back. There was no chance of this wage price spiral that people talk about. So prices go up, well, wages compensate, and so they can afford the higher prices. And so then prices go up higher, and then the wages compensate, and then the prices go up higher. So you need to have wages come up. Well, wages weren't following. This was a stimulus boom. Wages weren't coming up. And so it had to hit a brick wall. And I talked about that exact term prior to this for probably 6 months prior and saying, we're going to hit a brick wall. We're going to hit a brick wall. We're going to hit a brick wall. Boom, slam it all the way down to negative here. I think this is July. Let's see. I think it's July of 2022. Slam down to negative from 1% month over month to negative the next month. Complete brick wall. And then you can tell since then what has happened. It has turned relatively normal. This one. All right. And then I got to go back to this. And let's do US inflation rate month over month. Boom. And we got to go to monthly candle and we got to make it normal. All right. So if you guys remember this chart, what happened to my boxes? You son of a bitch. All right. So if you guys remember as well, during COVID, I was talking about uh, what was the term I used? It was pre-COVID normal, or God bless, I can't remember what the exact term was that I used. But anyway, I was talking about see how this is like kind of generally range bound, some negatives, some more positive, but generally positive and low. Okay, this is pre-recession normal. Maybe that's what I call a pre-COVID normal. And I said we are going to return to this same thing. And the reason why I said that was because that's how I see the economy. Okay. We are at the end of globalization. We're at the end of this great credit experiment and credit flooding of the world. We have diminishing marginal returns on credit, on debt. And so there's no place to really get inflation. The best we can do is just hope that net credit creation is barely above the floor, right? That's why growth and inflation is around 1 or 2%. And I said, we're going to see a return. Oh, I called it post GFC normal. Did somebody say that? Post GFC normal. So this was post GFC normal. And what had happened? We were basically post GFC normal. You could say there's actually a slight downward tendency here. Very slight. Okay. And this would match your recession. So recessions, if we turn on the recession bands, they always are where CPI crashes. Okay. So as we're going down, that means it's more recessionary. But if we are to think about what I was talking about with being more bullish into 2026, that's what we were talking about. Also, we can go to ISM PMI, and we can see this one came in real hot, or not hot, but it came in up. So remember, my base case for PMI was a continuation in this kind of stagnation, weird economy, I called it. But it looks like it might have chosen a direction. We'll have to see how this comes in following months here. But if this starts going up and we start getting a actual expansion in the economy, let me make sure this is all going out properly. Okay, my head is still a little bit in the way. There we go. So if we get some sort of return to like these expansions, see, this is the business cycle, boom, bust, boom, bust. If we get a boom here in 2026, we should expect that this goes up pretty rapidly. If that's the case, watch out. We're going to see a bull market in the stock market, a bull market in Bitcoin. Things are going to get exciting. But if we don't see that, and maybe we just see some struggling going up, so we see something like this, maybe. you know, don't know exactly how to draw that, but it kind of is limp and flaccid and it falls over. Um, then we're going to have to deal with that when that comes. But right now, people are talking about this breaking out and expanding in a new business cycle. And if that is the case, it's going to be positive, very positive for stocks. Then we're not in a pre-recession trade at that period. Okay, we're actually in a bull market. And then when we start coming down, then we talk about pre-recession trade on the downside. So again, if it goes like this, we're not in a pre-recession trade anymore. Then there we're in a pre-recession trade. And then when it gets all the way down here, obviously recession trade. But that's what I'm watching right now. Okay. So let me see if there's any comments. So all right. Well, that's going to do it then, guys. Thanks for hanging out. Make sure if you're watching this later, like, comment, subscribe. Appreciate this. I try to do these live streams for Fed events, for CPI events, for other live events. So make sure you guys are subscribed. And if you're watching on another platform, come over to the Telegram group, join it. Make sure you're subscribed to roguemacro.substack.com. You can check out bitcoinandmarkets.com, where I also have a membership site over there. So anyway, that's it for today, guys. Thanks for hanging out, and I'll see you on the next one. Bye.